Did your KiwiSaver just lose thousands of dollars? You're not alone. Over the last couple weeks, millions of Kiwis have seen their retirement savings drop, and fast. While the media is freaking out, here's the thing they aren't saying. This is normal. So normal, in fact, New Zealand stocks have had larger drops in 2020, 21, 22, and 23. And it might just be the best thing that could happen to your KiwiSaver. In this video, I'll break down the cause of the drop. There you go, and why you should keep calm and carry on. Panicking might be the worst move you can possibly make. So stick around, grab a coffee, and let me show you how to turn this market dip into long-term gains. First off, let's be clear. KiwiSaver is not a savings account. It is an investment. And like any investment, that means its value is likely to go up and down, sometimes drastically, as we've seen these past few weeks. Seeing a drop in your KiwiSaver can be stressful, especially if you've never experienced it before. But here is the key. Fluctuations are completely normal and, in many cases, even healthy. KiwiSaver funds are typically made up of a mix of growth and defensive investment assets. Owning debt, also known as bonds, is on the defensive side, while owning companies or stocks are on the growth or riskier side of things. When the world faces uncertainty and the financial markets take a turn, like we saw in these past few weeks, the value of these investments do tend to fall as investors react to the news. This, of course, shows up in your KiwiSaver balance. But here is the good news. The share market has always recovered over time. Here is the US stock market. Here is the Australian one and the New Zealand one. You get the picture. In fact, short-term dips often create long-term opportunities. And because KiwiSaver contributions happen automatically with each pay, you are automatically buying more investments at a discount during market downturn. In financy terms, it's called dollar cost averaging, and it's one of the most powerful features of KiwiSaver. So while it's tempting to panic while your balance drops, it's important to zoom out. KiwiSaver is designed for the long haul, whether that's retirement in 30 years or a house purchase in 5. The worst thing you can do is react emotionally to short-term noise. Instead, focus on staying in the right type of fund for your goals, keep contributing, and let time do the heavy lifting. And if you're not sure whether you're in the right type of fund for your goals, that's exactly where the team at Money Guide comes in. Money Guide are KiwiSaver specialists. That's all they do. They've helped over 4,000 Kiwis make sure their fund actually matches their life stage, their goals, and risk profile. Whether you are saving for a house, building towards retirement, or just feeling a bit lost after opening your investment app this week, they make the process simple. They're also independent, so they're not pushing one provider over another, and their advice? It's 100% free. If you want someone to take the guesswork out of it and make sure you're in the best possible position for long-term growth, head over to moneyguide.co.nz. They'll help you get sorted without the jargon. I've included a link to the Money Guide website down below in the video description. So what's actually going on? Let's break it down. Earlier this month, many KiwiSaver members noticed a decline in their account balances. This downturn is almost exclusively tied to Trump's shock tariff announcement on April 2nd, dubbed Liberation Day. He announced the 10% tariff was going to be slapped on most imports into the United States. Some countries, like China for example, face tariffs as high as a whopping 145%. All of this stuff is changing very rapidly, so by the time you watch this video, it might have changed again. Retaliation followed swiftly, sparking fears of a full-blown trade war. So why is this a problem for your KiwiSaver? Investors hate uncertainty, and tariffs this severe haven't existed since around the time the Titanic sank. This uncertainty causes investors to pull out of riskier assets like stocks and instead move their money into safer places like treasury bonds or even just holding US dollars. So that's one reason the market's dropped. But it goes deeper. Most US companies rely on global supply chains. Take Boeing here, for example. They source parts for their 787 jets from all over the world. When imports suddenly get taxed, these costs rise. Companies can either absorb the hit or pass it on to consumers. That creates cost-push inflation. Prices go up, household budgets get squeezed, and central banks might have to keep interest rates higher for longer. Then come the retaliatory tariffs, which hurt US exporters. American-made goods suddenly become more expensive overseas, demand drops, and jobs are at risk. On top of that, the uncertainty wrecks business confidence. Companies delay hiring, investing, and expanding when global trade rules change overnight. At the time this video was made, China has slapped a 125% tariff on American exports. In short, tariffs choke supply chains, push up prices, trigger inflation, and stall growth. Markets hate all of that, of course, which is why your KiwiSaver balance took a hit. KiwiSaver funds, especially growth and aggressive ones, felt it the most. These funds hold a much higher proportion of growth assets like shares, which are more sensitive to market downturns. The leading US stock index, for example, the S&P 500, even suffered its steepest two-day sell-off since the pandemic. To show why growth-focused funds were harder hit, here's a chart from ASB showing their 6 fund types. On the far left, you'll see the aggressive fund, and on the far right, the cash fund. For each fund, look at the split between income assets like bonds and cash in yellow, and growth assets like stocks in grey. The aggressive fund is made up of 94% growth assets, while the growth fund has 78%. On the other end, conservative and cash funds are almost entirely made up of income assets. So when stock markets fall, it's the growth assets that get hit first and hardest. It's not that these funds are poorly managed, it's just how they're built. They're designed to take on more risk for the chance of higher long-term returns. Meanwhile, conservative and cash funds, which are mostly income assets, were largely sheltered from the storm. So when the stock market crashes, it doesn't hit all KiwiSaver funds equally. The more growth assets your fund holds, the more your balance will bounce around. That's why knowing the type of fund you're in and whether it matches your goals is so important. The media has reported on many couples that did not change funds to reflect their goal of home ownership, which is unfortunate. That's where having an expert on your side can help, such as the team at Money Guide I mentioned earlier. If we look back at the ASB table of funds, you'll notice the minimum suggested investment time frame for the growth-heavy portfolios is higher. This is to ensure you have enough time in these funds to ride out any short-term market volatility like we've just seen. If you are planning to make a KiwiSaver withdrawal shortly, either for retirement or buying your first home, take note of this to ensure you're not caught out like these couples were. I was curious to see the overall breakdown of KiwiSaver assets. According to the Reserve Bank of New Zealand, in December last year, there was roughly $127 billion invested into KiwiSaver. Of this, $24 billion or 19% of funds were invested into New Zealand stocks like Spark and Fletcher Building, and a further $57 billion or 45% is invested in overseas stocks like Apple, Google, that kind of thing. So roughly 2/3 of KiwiSaver funds are invested in growth assets like stocks, which is why so many people have seen their balances drop these past few weeks. So now we know why markets are down and why your KiwiSaver balance might have dropped. Let's talk about what to actually do about it. Because here is the truth. This is where people often make their biggest mistakes. When your balance dips, the instinct is to panic, to switch to a conservative fund or stop contributing altogether. But history tells us that's almost always the wrong move. If you look back over time through the GFC in 2008 and the pandemic in 2020 and even the tech bubble back in 2000, markets have always recovered. Sometimes it takes a few months, sometimes a few years, but they always recover. And when that rebound comes, it usually happens fast. Miss it and you miss a huge chunk of long-term returns. This chart from CNBC shows just how hard it is to time the market. If you miss the rebound just 10 times in a decade, your returns look very different. This is why the saying goes, time in the market, not timing the market, makes all the difference. So what am I doing? I am staying the course. I'm not changing funds. In fact, on my private accounts, I'm putting in more. In fact, during downturns, that is when your KiwiSaver is doing some of its best work behind the scenes. As we talked about at the start of the video, it's called dollar cost averaging. Every pay cycle, your contributions by units in your fund. When prices are low, you're buying more for the same amount. It's basically like your investments are on sale. But if you panic and switch to a conservative fund during a dip, you lock in those losses. It's like selling your house in a market crash. You've made the loss real, and now you're sitting in cash, missing the recovery. So unless you genuinely need the money soon, the smart move is this. Check your settings, trust the plan, and keep going. Because KiwiSaver is built for decades, not days. Let time and compounding do the heavy lifting. So to wrap up, yes, your KiwiSaver balance may have dropped. But no, that doesn't mean something's broken. Market downturns are normal. They've happened before, and they'll happen again. But history shows us they've always recovered and often come back even stronger. The key here is to not panic. If you're unsure about whether your fund matches your goals, make sure to reach out to a financial advisor that specializes in KiwiSaver. Many providers have their own advisors in-house, or for an independent view, you could try someone like Money Guide that works across multiple providers. If you found this video helpful, hit subscribe and check out this video next, where I break down how KiwiSaver funds actually performed last quarter. Thanks for watching, and I look forward to catching you on the next one. Cheers.